Hi Fools, welcome to Market Checkup, the Motley Fool's healthcare-focused investing show. I'm David Williamson and I'm joined by Michael Douglas. Thanks for being here, Michael.
Happy to be here.
And we have a jam-packed show for you. We're going to go over some recent winners and losers. We have a big-ish pharma breaking itself apart. And we have, of course, Obamacare news, some news from the Hill about how legislation is going to be impacting several companies. So let's just jump right into it, Michael. Let's start with our winner. And our big winner this week, I think, is Carex, which continues to do well following the clinical trial success of Zeranex. Yesterday's pop, which is when they jumped, wasn't the news of new trial results or an FDA decision, but it came from the halls of Washington.
Right, so a lot to do there with some new legislation for the sustainable growth formula, the sustainable growth rate, the doc fix, as it's been called. Something we'll be able to cover sort of more extensively later in the show.
Into the show. And in this case, the doc fix was going to exclude ESRD drugs, which stands for end-stage renal disease, which is what Zeranex treats, and by removing extra phosphorus from people who are on dialysis. And what it's doing, it's going to take them from the payment bundle until 2024 instead of 2016, so it will be exempt from those heavy cuts.
Right.
Just a huge win for Carex, and really, this is potentially a huge rebound for them. This is a stock that was largely left for dead after parafosine failed in cancer. Big comeback story if they can get Zeranex approved. The date to circle on your calendar, June 7th. That's when the FDA will make its decision. All right, so let's move on to our big losers this week. And Michael, we actually have two. We get a 2-for-1 special on your losers. It's not what a lot of investors want. Although I think when you take a look at it, one of them is more of a potential bad news buy than the other. But let me give a brief rundown on the two, and then viewers can hear your opinion on which one you think should be maybe added as a bad news buy. So first up, we have Exelixis, which they were actually both down on trial disappointments. But Exelixis was down by over a third after an independent reviewer determined its prostate cancer trial for cabozantinib should continue, which for viewers out there asking, isn't that a good thing? Well, yes, it is a good thing. Unfortunately, it's not the overwhelming good thing, which is, I think, what a lot of investors were hoping for, that the trial would be stopped because the efficacy of the drug was just so monumental. They had to say, okay, it works so well, let's stop the trial early. I think it's more of an expectation thing here. But this isn't a drug that there's, I think, a little doubt now as well over whether this drug works in prostate cancer. But this isn't an experimental drug. It has been approved for thyroid cancer. It trades under the name Cometriq. So this is an additional indication. Now, our other sell-off is Insmed. It released phase 2 data for Arikayce that was mixed at best. The drug missed its primary endpoint in non-tuberculosis mycobacterial lung infections, but its secondary endpoint on culture conversion to negative was a success. Insmed also argued that, as drug companies are wont to do, that statistical significance may not have been there, but it was trending the right direction. But obviously, they feel like with the strength of their phase 2 data, they can push on, or the secondary indication in phase 2, they can press on for breakthrough designation and a phase 3 trial. So of these two sell-offs, Michael, which one do you think is a bad news buy?
I got to say, I like Exelixis a little bit better. For a couple of reasons, right? So first off, the trial is still going to continue. This means that there hasn't been necessarily terribly bad news. Now, we do have some questions on efficacy, of course, but at the same time, this is a second-line treatment, right? I mean, this was after people. There were a lot of comparisons to Xtandi or Zytiga because those trials were stopped early because of such fantastic efficacy. But this trial is covering people who had already been treated with drugs like Xtandi or Zytiga or docetaxel.
Yeah.
Therefore, I'm really not. It would take a lot to be, doing better than all of those drugs. So, I think there's still some good opportunity there, and I think people should be watching this stock and really any further news very closely to see if there's some opportunity there.
Well, what I like about Exelixis too is that this isn't just a development stage drug company. They have an approved product. They have a platform that I think has been validated. So I think the sell-off 30%. I know there's a lot of excitement about its potential in prostate cancer, or at least there was before this week. But I think that sell-off is overdone compared to the value of the stock and the rest of their pipeline. As far as Insmed, I think that is not a bad news buy. There are just too many questions surrounding it. I think it's a stay away. They had some problems, or at least there was some debate about a phase 3 trial in cystic fibrosis related lung infections. And so there are just too many red flags around that stock right now. But I think, I really do think Exelixis is potentially worth a closer look by, biotech investors who are willing to take on that clinical trial risk.
Right.
All right, so let's move on to our next segment, which is another pharma ripping itself apart. This is really all the rage.
Yeah.
I love it, though, because you know how much I dislike the conglomerate business model, Michael.
Right.
It is. I'm not a fan. So who is tearing themselves apart today?
Well, we've got Baxter International. They're going to go ahead and break off into two different businesses. One's going to retain sort of their core med tech business, your renal, your fluid systems, things like that. And the other is going to be this sort of pharma business. And their shareholder presentation, at least, really strongly emphasized the growth potential in that pharma business. The compound annual growth rate, biosimilars, and hematology and oncology. But at the same time, of course, pharma is a little bit more of a little bit riskier of a business than that sort of core med tech business. So I think there's going to be a lot to look at here.
Yeah, and I think this Baxter pharma unit is especially really focused in on a lot of earlier stage riskier biotherapeutics. I think it does carry some risk. I mean, to me, the comparisons are Abbott and AbbVie. Obviously, there was the Humira overhang for Abbott. For Baxter, there's competition for Advate from Biogen. It has Electate, and that is potentially going to take a good chunk of the market away from Baxter. I do think this is a smart move. Again, I always think the sum of the parts is worth more than the whole when it comes to conglomerates. They tend to trade at a discount. And when you take a look at the two businesses, this isn't to say biosciences isn't attractive, because it did $6.6 billion in 2013 sales compared to the medical products. That's the division that's going to retain the Baxter name. It's the sleepier, boring, some would say boring division. So $6.6 billion for biosciences, $8.7 billion for medical products. So on the surface, you're like, okay, that's the important division. But when you look at net income, bioscience did $2.4 billion, medical products only $1.4 billion. So when it came to the bottom line, bioscience was a lot more important and a lot more valuable. But I think this gives investors a chance to see what they want to invest in. Do they want to go with the riskier company? Obviously there's been some setbacks. There was one in Alzheimer's last year, but I'm always a fan of streamlined decisions. And I think when you take a look of whether a company should be broken apart, I always look at a small checklist. Can value be unlocked? Do these companies have synergies where it makes sense to keep them together? Or are their returns divergent, and do they need to be managed in a completely different way? And I think that's a dramatic yes to all of them. And I don't think these businesses necessarily belong together. So good decision by Baxter. I think there's a lot more upside in the stock now. I think it's trading in the low 70s. I've seen some estimates that say a split's worth another $10. So estimates are now getting pushed up into the 90s. So I think that's exciting. But we'll see. We'll wait till 2015 to see the split.
Yeah, something like that. Well, and the market seems to be pretty pleased with it too.
Yeah,
so
shares are up on the news.
I would say you're in the majority on this one.
It always feels good to be right, Michael.
Yes, sir.
All right, let's move on to the next segment, which is actually one we briefly touched on, which is the doc fix that's going around the halls of Congress right now. The House of Representatives earlier, just as we passed a one-year patch, as they want to do on this, over the sustainable growth formula. Why don't you tell our viewers exactly what that is and why they did it?
Sure. So the sustainable growth rate is it's basically from the 90s, when we were sort of really, really focused on deficits. And in 1997, they created this rate which basically says, okay, we're going to tie the increase in Medicare payments to 4 different factors, one of which is the growth of the economy. So for the first few years, the economy, it was the late 90s, grew a lot faster than Medicare reimbursements. But as we got into the early 2000s, things started slowing down. That was no longer the case. And so they began, starting in 2003, passing 1-year patches to basically say, well, we're going to ignore the sustainable growth rate, or the SGR, this year. And then the next year, they had to pass another patch to do the same thing. And the year after, and you're kind of getting the sense as to how this happened.
Yeah.
So yeah,
Best intentions.
Right. And so it's just been this consistent thing for the last 11 years.
So this is an investor-focused show. We're not just all policy here. In your opinion, what stocks are poised to benefit besides, I guess, Carrick's, which we covered earlier, is our weekly winner?
Right. If physicians had a stock, that might be a stock that could benefit. But as does providers, your hospitals. And when you look at the amount of the decline if they do not pass this SGR, it's a 24% cut to Medicare reimbursement. So when you look at a place like Tenet Healthcare, they've got they get the low 20s of their revenue from Medicare, about 22% last year. So that's a fair amount, right? Losing a quarter, that's a big deal. But when you look at other chains, like the more rurally based community health systems, based on last year's numbers, which don't include the HMA buyout that they just finished, and rural populations skew older than urban ones. We're talking 25% of revenue from Medicare, and with LifePoint, we're talking the low 30s, 33% last year. So that's
which is the most rural focused of all of them.
Right.
Yeah.
So that's a pretty big amount for each of these. Yeah. So if this passes the Senate and is signed by the president, I think a lot of people are going to be breathing a big sigh of relief.
Yeah, because you're never sure, sadly these days, even common sense legislation like this that stops severe cuts from happening. You can't always trust it to get passed. So, why did the AMA then urge the House to pass the bill, and why were certain physicians unhappy with a bill that gives them money essentially?
Right. So the AMA and a lot of physicians aren't happy with the bill because they want a long-term fix, right? I mean, there were a couple of patches that actually sort of got them to this point. Originally, these cuts were supposed to kick in I think December or January, and they patched a couple months at a time until now. What they really want is for it to just be done, for the SGR to just be completely gone and replaced with something else. The idea being, and reasonably enough, we don't like uncertainty. Nobody likes uncertainty, and so they really want to know that they're going to
overhang, every year.
Exactly, a tremendous one, and one that really I think frustrates a lot of doctors and providers. So something we'll be watching closely. Still has to go through the Senate and has to be signed by the president, but so far so good.
That's what we like to hear. All right, so let's stay sort of in the corridors of Washington.
Sure.
Although this is another. Merge of business to Washington. There's been some news over copays ending. Now, 2 of the big pharmas, Merck and GlaxoSmithKline, have stopped their copay assistance for Affordable Care Act patients. Now, the concern is that they're afraid subsidizing drug purchases will actually be essentially illegal due to federal anti-kickback legislation. A lot of the other top drug makers, though, they're still just plowing ahead with this. Novartis, Sanofi, Lilly, they think it's fine. Pharma, which is the industry trade group, also thinks it's fine. But there is some confusion on whether it actually is or isn't.
Right, and understandably so. So on the one hand, like Medicare and Medicaid patients, you can't do these sort of kickbacks. You can't say, hey, listen, you have to pay $50 in copay for this branded drug or $10 for this generic, but we'll give you this coupon for the $40 difference so that you'll get the branded drug. You can't do that with Medicare or Medicaid. But HHS Secretary Sebelius basically had said previously that insurance plans sold through the Obamacare exchanges aren't federal programs, right? So they don't fall under that umbrella. But more recently, the Centers for Medicare and Medicaid Services, or CMS, said that they encourage, and I'm going to quote here from Bloomberg, issuers to reject such third-party payments. So it's a little bit confusing.
Yeah, I got to say, I think Merck and Glaxo jumped the gun here a little bit. If they weren't being told to knock it off directly, and apparently they weren't because all the other drug companies are plowing forward with this. Copays are a good way to get customers to use their more expensive branded drugs. Otherwise, they're not affordable for a lot of people, and it's a good way to fight off generic. So it's a tough business decision to say we're not going to do copays anymore. I wonder if they were being a little too cautious.
Well, and especially given that 9 of 10, according to an Avalier report, 9 of 10 insurance plans in the Obamacare exchanges are using specialty tiers. They basically require patients to cover between 20 and 50% of the cost of some of these really expensive branded drugs. I mean, that's really unaffordable for a lot of people, especially a lot of lower income people who are eligible for these subsidies in the exchanges. So I think we're going to see a lot of pushback, and it'll be very interesting to see sort of what the government ultimately does about this.
I think a lot like the doc fix, there needs to be sort of a clear, permanent legislation, so these businesses can operate in an environment that's that's best
stable
for them, without overhangs.
Yeah.
All right, so let's move on to our final segment, Obamacare enrollment, which we love. We
do.
We actually had a bet on it last week, but it looks like the Obama administration are fans of football, Michael, and not the NFL, but European football, because everyone thought when the clock struck midnight, and it became April, enrollment was done, game over. But it turns out there's stoppage time.
Right. So it was interesting because there was this trickle at first, right? Hearing that the Minnesota Health Exchange and I think Oregon too, and a couple of the others,
it had a particularly buggy exchange.
Right. Had basically said, well, if people are having technical difficulties on the last night, we'll go ahead and give you an extra day or two. And then Health and Human Services said, well, we're going to go ahead and operate in an honor system for people who have already started their search and have made an account and all that. If they haven't finished yet, we're going to go ahead and take it on the honor system that they will say that, well, the tech messed up at the last minute, we didn't have enough time, something like that. And they haven't said how long they're going to extend it
it's
for.
like stoppage time.
Right.
I love that analogy because it's just sort of this vague, nebulous period, but the game is still going on. And I even saw that you don't even have to necessarily have a profile. You can just argue that you tried to create a profile and potentially get an extension.
And technical difficulties got in the way. Yeah. So it's going to be interesting. I think that some of our insurance companies have got to be happy about this, though, because
the more the merrier.
Right. Well, there's that, right? So that's going to make those risk pools a lot bigger so that they're really sort of more difficult to insure. Sicker people have probably already signed up because these were the people who were being denied insurance in the first place. I've got to think that this is going to skew toward more younger, healthier people. So, Aetna and Humana have both said we expect to lose money. I'll be interested to see how much money they lose and if they actually do lose money, once the dust has settled from whenever this stoppage time ends. I think this could benefit WellPoint's profit long term as well. There is another strain of thought which says that people who just got sick are going to sign up at the last minute, but
I feel like that's such a nebulous, murky, and probably small number compared to just the people who procrastinated.
Yeah, I don't buy that. Yeah, I think it's going to be largely our young people, and we saw that from the Massachusetts experience, right?
Yep.
A lot of young people at the very last minute. So we'll have to see, but I guess that means our bet's kind of off or changed.
I want out of our bet. Equally as important as the extension news is our bet, which is I went out of it. I predicted 5.9. You predicted 6 on the nose.
Yep.
I'm not doing 5.9 anymore. In fact, if you're going to stay at 6, if you're willing to stay there, I'm going to go the other way.
You're going to go over?
I'm going 6.3.
Yeah, I'm not even going to fight you on that.
I'm going 6.3, and I'll tell you, Charles Gaba, who's done a really good job. He has a site, acsignups.net. He's now guiding for 6.5 because of this extension, possibly higher. So it looks like we actually could really have a huge surge at the end here.
Right.
So stay tuned for that. We'll find out, hopefully at some point, when our bet resolves. We don't even know exactly when enrollment will close, but we will find out. And stay tuned to Fool.com for all your other healthcare news as well. Thank you for Michael Douglas. I'm David Williamson, and have a good day. Fool on.